Sadikoff here, and today I wanted to share with you the California housing market forecast. This was put together by Jordan G. Levine. He's the Deputy Chief Economist at California Association of Realtors. Lots of useful information in this report, so I figured that I would go over the report together with you all and point out some of the key findings in this report and answer any questions that you may have, and please post them in the comments. Also happy to share this report with you. If you'd like to shoot me your email address, I am happy to send the PDF report over to you so you can look at all the pages of this report, and there are 68 of them. So we're going to go over, again, the main key findings of this report, and without further delay, let's get started. So let's start with the good news. And the good news is that the California COVID-19 trends have been going down. And we are seeing decreases in the new deaths, as well as 7-day averages are continuing to decline. More on the good news, consumers are feeling more confident over time. And this is a confidence index put together by University of Michigan. And what we can see is that the confidence levels are going back up. They were certainly very, very high pre-COVID. Things changed during COVID, and now the confidence levels are steadily increasing. We also see increased and accelerated spending in the US. Again, kind of on the same pattern where we had a decline right after COVID, and post-COVID, we see the numbers accelerating. We see a sharp rebound as well in the GDP growth. GDP growth declined by 31% and jumped back up by 33% in the third quarter of 2020. Now, what's going on in the labor markets? Pre-crisis, we had 17,604.5. This is the number of employed. I believe it is in millions. And jobs lost by April 2020 are in the magnitude of 2.615.8. Rebound through September of 993.6. So there's still a delta of 1.622. And these are the jobs that were lost and have not been recovered. What's going on in the unemployment? Unemployment rate has been consistently going down post-COVID, and we are now at 11% for California and 7.9% unemployment in the US. Really not huge news here. Interest rates have never been lower. I think I've seen 2.75% for a 30-year fixed. I've never seen anything lower than that in the 10 plus years of doing real estate. So whether you're buying a home or refinancing, it is a great time to seize the opportunity with these low interest rates. This is a good one. This was a Google consumer poll. And as you can see, it goes back as far as September of 2018. And in September of 2018, about 20% of people thought that it was a good time to buy a home in California. We're now looking at 34% thinking that it was a good time to buy a home in August of 2020 and 28% in September 2020. In terms of whether it's a good time to sell a home, a lot of people actually right after COVID thought that it was a bad time to sell a home. And I think they were right. We didn't have any protocols in terms of showings. All the open houses got canceled. So there's really a lot of uncertainty about how to go about an escrow process. How do you start with showing a home? How do you go about getting inspections done? And as all of these things got resolved in the industry, so did the consumer index and consumer confidence in selling homes, which is good. I'm going to skip this one and this one. again, I can email you a copy of this report if you are a data um, geek and would love to get every single piece of information. I'll send you the whole PDF, and you can look through it. And definitely, if you see something I didn't see and would like to uh, give me some information on that, I would love to hear from you. We also see here from this slide that serious delinquencies peak outside the main urban areas. And forbearances are among highest risk of profiles. If you remember, we had a 3-month forbearance implemented right after COVID, and there's still a lot of forbearances out there, and it simply states that they are among the highest risk profiles for homeowners. They do have lower FICO scores, higher debt to income ratios, etc. Out of those forbearances, 41% have since exited, which is great. 6% have paid off their mortgage, 30% are not performing, and 5% are delinquent. This next one is actually pretty nice. I'm going to skip to California overall because I think most of the people watching here are going to relate mostly to the Bay Area market. And what we have going on in the Bay Area, this is as of September 2020, we have a 34.2% year-to-year increase in existing home sales. So that's a huge jump. We also have a 20.5% year-over-year increase in the average sales price of homes in the Bay Area. We also see that there is 1.9 months of inventory in the Bay Area. Now, in the normal market, you would expect to see, or in a balanced market, I should say, you would expect to see about 6 months of inventory. We only have 1.9, which means it's a heavily seller's market, heavily skewed towards seller's market. Also reflects in the days on market, just 13 days. It means as soon as you put it on the market, you just have a few showings and the home is gone. We just got into a contract yesterday for a buyer on a home that was listed 3 days ago, and it's now in contract. So things are moving very, very quickly. And also this is another evidence of that. Homes are selling at about 1.5% over their list price. We also have some details by county. We got Sonoma County, Marin County, Napa County, San Francisco County, so broken down by counties. Send me an email for the PDF. And it says, keep the champagne corked for now. I like that. So there's some bad news coming here. What are the bad news? The bad news is that we still have lots of financial distress. U.S. continuing unemployment insurance claims plus PUA. So this is pandemic unemployment assistance. And we can see that in the U.S., unemployment insurance claims have been steadily going down, and the pandemic unemployment assistance has been also, the claims for that have also been declining. I'm not sure how that's bad news. That's actually pretty good news. But I guess the bad news is that there's still a lot of unemployment insurance claims out there. A lot of people are still unemployed, struggling to find jobs, and that is still a big concern out there. This is actually a good representation of that statement in the bar chart form. So we can see that in the previous recessions, so for example, 1970s, 1980s, it gives you the number in thousands, right? So this would be 4.6 million, 4.7 million people were unemployed in 1980s recession. In 1990s, it was 3.5 million unemployed. In 2000s, it was 6.6 million people unemployed. 2010s was 4.8 million people unemployed. And now we have 30 million people combined receiving unemployment insurance and pandemic unemployment assistance. And that is 3 times more than prior worst period of unemployment. So it is a pretty big factor out there that we should keep an eye on and hopefully see a transition of these unemployed people from being unemployed to getting to getting employment. Stock market recovery, encouraging or worrying? I mean, you be the judge. This shows you the PE ratio at its highest. It was at 22.6, and that's how the stock markets measure the overall prices of equities. And 22.6 means they were pretty high, priced pretty high. They've dropped in 2007, 8, 9, 10 during the recession, and then ultimately started going back up, and now we're at 18.6. So I guess what it's showing here is that we are approaching that peak here where we had the last recession. Let's see, what else do we know? Lots of delinquency to reckon with eventually. So California mortgage delinquencies, this is showing 2009, and it's no secret that in 2009, 2010, 2011, we had a lot of delinquencies. And then delinquencies ultimately started going down, and then poof, explosion here. And of course, these are associated with the COVID-19. So again, still not out of the woods. And I think all the message that I'm getting from these slides is that we should continue to be cautious and just continue to look at the trends and what is happening. But it's also painting a picture that what we're dealing with today is drastically different from what we were looking at in 2009, 2010, 2011 recession period. Let's look at what else we know. I'm gonna skip this one and this one and this one. There are some good ones at the end here. I think all of what these are doing, these are just looking at the slice of information that we already looked at, just going in a little bit of more detail on the different price ranges and what's going on in the different price ranges. And then it goes into a section where it's reaffirming the fact that the prices ultimately that you see in the marketplace for real estate are all supply driven, and it is not a surprise. Price is a correlation of demand and supply. I'm going to skip to the end here and see what the realtors are saying. Realtors are saying that do you think next week listings will go up? So realtors think that listings are ultimately going to continue to go up, and realtors are also believing that sales will go up. More listings, more sales, which makes sense. And they also believe that about 30% believe that prices will go up. So what is the forecast? The forecast is that the US GDP is going to grow by 4.2% next year. Non-farm job growth is going to go up by 3% next year. Unemployment is going to go down to 7.1%. CPI, which is the Consumer Price Index, is going to go up by 2.1%. So things are going to be more expensive. And the disposable income is going to go down. So things are going to be more expensive and there's going to be less money to buy them, which is not a good combination. But this is talking about all of California. When you're considering to buy or sell a home, real estate in California is very pocket specific, meaning you could have appreciation in one pocket and depreciation in the other. Reach out to me to discuss any particular pocket that you're interested in, and we can dissect and analyze it together, and I'm more than happy to give you all the information. So what could become a problem? Well, foreclosures could become a problem because, as you remember, we looked at a slide. Even though a lot of people are coming out of forbearances, there's still a lot of unemployment out there. A lot of the retail was affected heavily. Any jobs that require person-to-person interaction that cannot be done virtually have been affected, and a lot of those people are homeowners. So that could ultimately become a problem, and it all depends, on what is going to be done on the government side in terms of stimulus, in terms of forbearances, and how that's going to be handled. That all remains to be seen. And of course, we just heard news of Pfizer working on the last stage of their vaccine, which is great news because that could change things a lot. What it entails for the real estate industry as a whole. So there's a lot of things to look out for in 2021. Lots of information that's going to be coming our way, and we have to stay educated on all of this information and make educated decisions based on what's coming in. This is a pretty good slide, a very, very encouraging slide, and it shows the ratio of the median priced home in California and the median HELOC volume. So one of the things that drove the real estate industry into recession was homeowners were maxed out on their loans. A lot of the times they had loans, and as you can see in 2006, the total amount of loans actually exceeded what the home was worth. And of course, since then, a lot of things have changed. The qualification process has changed dramatically, and that drove the balance towards a more favorable picture where we have a lot more equity in the home compared to the outstanding loans. So again, when I say things need to be assessed information at a time, it's because a lot of times the buyers and the sellers that I talk to, or some of the questions that I receive, are comparing any kind of possible real estate recession with what happened in 2008, 2009. And what I think these slides are telling us is that the pictures are completely different. What happened in 2004, 2005, 2006, 2007 that ultimately led to recession in 2008, 2009, 2010 is completely different in the mechanics of it and what's going on behind the scenes compared to what we have going on right now. And that is encouraging news. So what else do we know? Not as many fundamental problems in the mortgage market. And this is to reinforce the point that I just made with the previous slide, which is in 2005, 33% of applications and 47% of volume was in ARM lending. And that was risky lending types where you would lock in an ARM loan for the first 2 to 3 years. And then your interest rate could sometimes double after 3 years. So ultimately driving your monthly payment up and making it very burdensome to make that mortgage payment. Well, today, today in 2019, we have only 7.9, I guess this is the latest data available, which is 2019, was 7.1% of applications. Only 7.1 was applications for ARM lending and 15.6% volume of ARM loans, which is more than 3 times less than what we had experienced in the 2005. Let's see, and household balance sheets are in much better shape. So this is debt to service ratio, and we can see that that is hovering at between 10 and 12%, and actually has come down quite a bit. And financials obligation ratio has also come down quite a bit. So that just tells us that there's not that much debt today as compared to 2008. The debt is significantly down, which is again a good comparison with what was happening in 2008 and why what we're experiencing today is quite different from that time frame. So this is the last one we're going to take a look at, and then I'm going to wrap up with some closing comments. And what we see here is that prices weren't as inflated as they were in 2005. So This ties in very well with the last slide, which is 72.6% was the portion of your mortgage payment for home buyers in 2005, 2006, 2007. So for example, if you made $100 a month, you paid $72 of it, $72.60 out of that $100 every month on average for your mortgage payment. That was ridiculous. We have much more stringent qualification standards now. Buyers need to provide their incomes, credit scores need to be really nice and high, and incomes need to be verified. And a lot of times, lenders require at least 20% down payment in order to qualify for a loan. And all of these changes, positive changes in the lending industry, have led to a sharp decline in that percentage. And ultimately, we have the average at 43.2%, which is in line with the historical average we have here. So these are the kind of things you kind of want to see if you're thinking about buying or selling a home, because when things are more towards the averages, that you know that they can't really change much up or down. As a matter of fact, they can probably change more towards the upside historically than the downside, unless you're in the 1970s. Okay, like I said, this would be the last slide. Please share your email address if you'd like to get a PDF version of this report. It was fun going over it with you together, and I look forward to seeing your questions. Thanks so much for tuning in, and see you next time.